George Cipolloni, one stock you like in your 5-star Chartwell Berwyn Income Fund is Nintendo. Now, Nintendo's up almost 50% in the past month because of Pokemon Go. So how much more can it run?
Sure. We really like Nintendo, and we bought it for completely different reasons. We bought it because they have a great balance sheet. 75% of the assets on the balance sheet are in cash and investments. They have roughly $8 to $9 per share in cash when we bought the stock, between $15 and $18. Our average cost is around $17. The one thing we did notice was that there was a CEO change and then a strategy shift. And that strategy shift was intended to license this IP that they had. They have a treasure trove of intellectual property and characters. And so once we noticed that shift in strategy outside of their consoles, we really thought that the stock could go up a lot. We had no idea that Pokemon Go was going to be such a huge success so quickly. And again, that value from Pokemon Go will not be enough to justify the move in the share price currently. But we think longer term, given their portfolio of assets, that Nintendo strategy shift can lead to really good things.
And you're also bullish on Philips. Now, they recently spun off some of their company. They spun off the lighting.
They did.
But they still are kind of a pure play in healthcare technology now. So is this the right way to go? How much more can this lift the stock?
Certainly. So with Philips, again, we saw a strategy shift. The lighting business could be very volatile from a margin standpoint. It was in the mid to under 10% margin range. The healthcare business is over 10%. Their consumer business is over 10%. So spinning off that lighting business, they're going to generate some cash for the company, which is great, and then they will redeploy that into higher margin sectors, which should lead to higher return on capitals and a higher share price.
And you like Scripps Network Interactive. Now that stock's up around 20% year to date. So I guess all that talk of cord cutting not affecting Scripps as much, is that what's going on?
100%. Scripps has a really, really good business with HGTV, the Travel Channel, Food Network, all those really core programs that people like to watch. They have a great demographic for advertisers. Their returns have been really, really good over a long period of time. 12% return on capital, on 60+% gross margins, on 30% plus operating margins. The stock was trading cheaply because everybody just thought that their results were going to get hurt with cord cutting. But the stock was trading at 12 times. We took a position, and we were very happy that we did.
All right, and then finally, Landauer. Now, they have devices that monitor radiation. Stock's up around 30%. They have a very good military business, and I think that's really helping the stock of late. Tell me more about Landauer and why you like it.
Sure. So Landauer is a company, it's funny, it was one of the first stocks I looked at back in 2002. We never bought it. They went through a few management changes. They really messed up the balance sheet, and then it became a value stock again. So we looked at it. We love the radiation dosimeter business, huge margins. They have 72% market share in one segment of that market. So again, there's a basis there for a really good business. There have been some changes from a regulatory perspective in the healthcare industry that we think will help them get some really decent top-line growth that should flow down to some really good profitability growth in the future. And given what we paid, we bought it in the high 20s to low 30s. We thought it was a really great value there.
All right, well, thanks a lot, George.
Thank you, Greg. Appreciate it.
Thank you for watching The Street.